in terms of the CPI numbers, we are still watching the core because we believe that the Fed's mandate is around the core inflation, and that wasn't as bullish as the headline for equities. So in our portfolios, we're moving a little bit closer to a more neutral position where we've been long equities, long spread, and a little bit long duration as well.
Colin, does that mean you've enjoyed some of the rally that we've witnessed at this point, and you're effectively just turning those paper profits into hard and fast cash at this stage?
Absolutely, because I don't think we're out of the woods yet, because we're still seeing the lag data in terms of employment and inflation looks okay, but if you look at some of the more real-time data, plus what's going to happen if we project these forward into year end, that's not certain that the US is going to avoid recession. If the Europe avoids recession, that would be a very small probability, and then China, the slowdown there, driven by the property sector. So overall, I think we've benefited from the rally, and it's just a case of we should take some profits from that, hold our cash, and then during bear markets, you'll always come out at the end of it, but you've got to have the capital to put to work at the end.
Colin, can I test your resolve and conviction on that move? Because look, after yesterday's bounce, you know the numbers as well as I do. We've got a 3-month high on the S&P. We've got a 2-month high on European headline markets. We've got a 20% bounce off the June low for the NASDAQ. It's a bold move, isn't it, to start getting out of equities just as you've got a rally?
Look, we're still down year to date, admittedly off very high levels. Valuations are still expensive. The earnings season was good, but do we think that that's going to continue into the end of the year and support markets? But if the Fed is trying to slow the economy, reduce aggregate demand, and also slightly rise unemployment, then that's going to be difficult for companies to continue to generate those sort of earnings. So for me, it's the valuation argument of saying, look, things are still expensive, the outlook is still pretty poor, and therefore we need to be a little bit more safe and cautious at this particular time. You take the returns when the market offers them to you.